Welcome everyone, and thank you very much for joining our Digital Services VAT webinar. So firstly, just before we dive straight into things, just to introduce ourselves quickly. So my name is Ashley, and besides me is my colleague Natasha, and we both work in the digital services space at VAT IT Compliance. We actually see a few of our clients here with us today, so it's great to have you here and welcome as well. Just a bit more about what we do here at VAT IT Compliance. So we obviously offer specialized VAT services, and we also offer US sales tax as well as e-invoicing and the like. So just on the agenda for today, so you can know what to expect, is firstly, what is Digital Services VAT? Then I'll go into why this is applicable, as well as knowing your obligations, and then the EU historic project, and then I'll touch on platforms and marketplaces, and then also digital services tax in comparison to digital services VAT. And then we'll just wrap up with a few key updates as well as a Q&A. All right, so let's get into it. Okay, so firstly, what is Digital Services VAT? So as we are aware, value-added tax is a consumption tax borne by the end consumer and essentially should not be a cost to a business. So it shouldn't really be an expense, obviously barring certain factors. So the basic principle is that a business would incur VAT on its purchases, so that would be your input tax, and then charge VAT on its sales, being your output tax. So Digital Services VAT differs in that it applies to online transactions where there's minimal human interaction. So as a result, businesses typically do not incur input tax since the service is provided directly to the end consumer. And then it's also generally levied by the country where the consumer resides, as opposed to like where the business is located. So that's just a little bit as to how it differs. All right. And then obviously now, why is this applicable and what would be some of the implications of not knowing your obligations? So if a business fails to register or pay VAT, it can expose the company to significant risks. So I think the first thing that would jump to your mind is financial risks. So there can be financial penalties and fines like that of late payment, late filing, and in some cases even tax evasion. That is obviously a criminal offense and would be your worst case scenario. There would also be backdated VAT liabilities. And again, this might not be something everyone thinks of first, but it can indirectly affect your cash flow because now you have to reconcile these backdated VAT liability amounts, and it can raise audits. And I mean, we all know audits aren't really fun. And then there's also difficulty in securing financing. Again, it's not something you might think of like off the top of your head, but financial institutions often communicate with the tax officers. So they want to ensure that taxes are properly assessed and collected. So this is quite common in Europe, and it is something we especially see in Europe. One way to mitigate this would be through an option known as the Voluntary Disclosure Program, or for short, you might hear us refer to it as VDP. Natasha will discuss this in a more practical sense shortly. However, it essentially allows a company to proactively inform the tax office about errors, omissions, and inaccuracies without being prompted by the tax officers. So essentially, you're kind of owning up to your mistake or owning up to your error. So one of the advantages of this is that the tax office will often waive, if not all, at least part of the penalties that have been incurred. Now I will just pass on to Natasha, who will discuss the EU historic project.
Hello, everyone. I do first want to let you know my voice did start acting up this morning, but I have water on standby, so don't worry. So we have observed many companies that were unaware of their VAT obligations within the EU until significant time has passed. The lack of awareness is often due to complexities of the cross-border taxation, varying regulations across each member state, and the evolving VAT compliance requirements. As a result, businesses fall out of compliance, which can lead to significant financial penalties, interest charges, and reputational damage. Correcting such issues can be time-consuming, and costly. To address this, we have established an EU historical project, a structured-based project which will help businesses retroactively comply with their VAT obligations while helping minimize the risk and potential VAT liabilities. In the EU, the VAT registration and threshold is based on where the company is located. So for companies that are not located in the EU, which is a non-EU company, there is no threshold, which means that a registration is required from the very first sale, which is made within the EU member states. This applies to non-EU businesses selling goods or digital services to EU customers. For EU-based companies, a VAT registration threshold differs across each member state. However, most do follow the EU guidelines of a 10,000 euro cross-border sales throughout a 12-month period. Once the threshold is exceeded, a company must register for the VAT. To simplify the VAT reporting within the EU, businesses can opt for a one-stop shop, which is an OSS registration. This system allows businesses to consolidate the VAT reporting for all EU member states under a single VAT return. The tax authorities in the country processes and distributes the VAT payments and the declared sales to the respective tax authorities in the member state where the sales had occurred. This greatly reduces the administrative burden of having multiple VAT registrations across the EU. However, unfortunately, the OSS registration cannot be backdated, meaning any historical sales cannot be declared in the OSS, and therefore individual VAT registration in each applicable member state could be due. The process currently is registering for VAT in each member state where historical sales were made, keeping in mind that each country has its own policies and timeline, then submitting the VAT declaration for the past sales, paying the VAT liability along with any potential interest and penalties, and then deregistering for VAT once all historical compliance obligations has been fulfilled because you are now filing through the OSS scheme. For the EU historical project, it is only applicable for businesses who currently have an OSS registration or plan to do so in the future. There are a few member states that allow the historical sales to be included in the OSS, effectively consolidating all the past sales into the system without having a separate VAT registration. However, this is entirely at the discretion of the respective tax office, and approval for this approach is rare. So, some tax offices do not permit backdating in the OSS. Currently, there is only a small number out of the 27 EU member states which could consider this option. However, approval is typically on a case-by-case basis. Given the complexity of the regulations across the EU, it is crucial for businesses to assess the VAT position carefully and take proactive steps towards compliance, as non-compliance can escalate in significant financial risks as well as legal complications. Failing to properly declare the historical sales presents several risks for businesses, such as if all historical sales are included in the first OSS, especially for the member states that do not allow for this, the tax authorities may notice a discrepancy over time. Like, for example, in one OSS, if you have filed over 100,000 of sales, because this is the sales over 4 to 5 years, and then in the next return, you only file 5,000, there's a big difference, and this will raise flags for the tax office. And therefore, this could trigger an audit and require companies to refile and use the correct processes. Incorrect filings could also lead to additional surcharges, as in some cases, when the tax office can see clear non-compliance, the penalties tend to be higher. If no declaration was made at all, the tax authority may initiate audits. As Ashley has mentioned earlier, the EU tax offices, local banks, as well as foreign banks do share financial information with each other, making it easier for authorities to detect undeclared sales. For instances, in Denmark, they have been proactively contacting companies for audits where they have noticed that there is undeclared sales through bank transactions, and they know how much a company is supposed to declare. Once one tax office is aware of the non-compliant, they communicate with other tax offices, which will potentially lead to multiple audit requests. There is a voluntary disclosure program, which Ash has also mentioned, the VDP, which allows businesses to voluntarily disclose the unreported, unpaid, or even incorrectly filed VAT. Often, this is in exchange for reduced penalties or interest. For companies that have not yet received a formal audit request, many EU member states allow for the VAT registrations under the VDP, offering significant lower surcharges and possibly allowing for the penalties to be appealed. If a company has already received formal requests for historical registrations, immediate action is required. Please reach out to us for some guidance on appropriate next steps to ensure that compliance and to minimize the risks for you. Please also just keep in mind that the VDP is not only for the EU, it is for international. There is many countries where allow companies to go to them and say, hey, we're sorry we didn't declare our historical VAT, but this is what needs to be declared. And in those cases, the tax offices are often more lenient. I'm now going to give it back to Ashley, who's going to help explain the treatment of platform as well as marketplace sales.
Okay, thanks, Tash. Okay, so yes, jumping into platforms and marketplaces. So off the top of your head, this might be something that you think is the same thing. In this context, it is not, and there's, a bit of a different treatment. So it is important to be able to differentiate between the two. So as mentioned earlier, since Digital Services VAT typically services online streaming, software, ebooks, and other digital products or services, being aware of this difference between a vendor and a platform matters. So firstly, what exactly is a marketplace in the digital services field? So by definition, a marketplace is a digital platform that facilitates transactions between third-party sellers and their end consumers. So an example of this could be Google Play, Amazon as well. So essentially, it's a digital platform and it's enabling that transaction from the third-party seller and then to your end consumer. And now in some jurisdictions, marketplaces have the responsibility to list VAT inclusive pricing, and it would be their responsibility to collect and remit this VAT. So in essence, the VAT would now not be accounted for by the seller. So they no longer have any of that responsibility, that VAT responsibility on those sales, but rather now the marketplace. So it is also just important to keep in mind that some jurisdictions do have a marketplace threshold, and only then would this apply. So in Switzerland, for example, as of January 2025, so Jan this year, marketplaces that generated over 100,000 Swiss franc in turnover must register with the Swiss tax authorities and are therefore responsible for collecting, reporting, and remitting the Swiss VAT on the sales made through their platform. So it's important to also just keep in mind that if a marketplace fails to comply with the new registration and reporting requirements, Swiss custom authorities can possibly refuse entry to goods or even destroy non-compliant goods. This example is a bit more relevant to the enterprise side of things, but it is definitely just good to keep in mind. So now considering this, it's important to think about how any changes might affect VAT registered traders moving forward. So especially with any updates to current regulations. So it's crucial to understand which countries require marketplaces to collect and remit VAT on behalf of sellers in the first place, and then how to determine which sales create a VAT obligation for the seller. This helps prevent issues such as, double taxation, underreporting, or even just failing to register for VAT when required in the first place. Again, something else to just keep in mind, there would now still be a shared responsibility for any VAT liabilities between the trader and the marketplace. So this would raise a few considerations, like whether traders should address these responsibilities in contracts with marketplaces. So that's just everything in a nutshell on platforms and marketplaces. And now I will move on to digital services tax and how it differs from digital services VAT. Again, I think a lot of people mistake these for the same thing, but they are two different concepts with two different treatments. So digital services tax, or I'll just refer to it as DST for now, is a direct tax on the revenue of digital services targeting large international companies that generate significant profits from digital activities without necessarily having that physical presence in the country that's imposing the tax. An example of this would be Netflix. It's a large international company, generates significant profits, and its activity, us watching TV shows from Netflix. So that's just like a quick example. So in summary, digital services VAT is an indirect tax for the business and affects consumers directly as it is paid by the end customer. So as I mentioned earlier, it's borne by the end customer and should not necessarily be an expense to the business, again, barring certain factors. While DST, so your digital services tax, is a direct cost to a business and is aimed at taxing the profits of large firms operating in a particular market. On average, the DST thresholds are relatively high and in some cases cover very, very specific services. So for example, it might only cover online advertising or only streaming or broadcasting even. So it is just very specific. In some jurisdictions, there is no threshold when registering for your DST. So an example where there is no threshold is Kenya. So basically, as soon as the date of your first sale is when you would need to register for DST. Something to keep in mind, it's important to note that as of December 27th, 2024, so December of last year, DST in Kenya was repealed. And then in its place, Kenya introduced something called Significant Economic Presence Tax, or for short, SEP tax. It's a very similar concept to DST. But again, it's important to note that should you have historical VAT returns, you would still need to do your digital services tax, but moving forward, your SEP would apply instead. So your significant economic presence tax would apply moving forward. So it's just definitely something to keep an eye on, especially if you are operating in Kenya. And now I will pass on to Tash, who will do a few key updates.
I'd like to just take a moment to update you all on just some of the few important tax changes across various jurisdictions that will impact, which will impact the digital service providers. In Japan, starting from April 2025, digital platform operators and marketplaces will be required to collect the consumption tax on behalf of the service providers. This is what Ash has just spoken about. So in the cases of Japan, Google Play, for example, will therefore collect the VAT and remit the VAT. The seller will not have the obligation. In the Philippines, starting from June 2025, non-residential service providers will need to register for VAT. The registration process can be initiated now, but the effective date of registration will only be June 2025. In Peru, as of January 2025, a VAT registration will be required for non-residential digital service providers who are making sales in Peru. There is no threshold. So also in Peru, if you are making a sale, please reach out to us so we can help you with that. And then in South Africa, effective from April 2025, digital service providers that are non-residential may not longer need a VAT registration only if they only sell to VAT registered businesses. This will be applicable under the B2B reverse charge mechanism. However, the catch is, if a business makes B2B and B2C sales, then the mechanism will not apply at all to that company. So then a registration is required, and then VAT will be due on the B2B and B2C transactions. In Sri Lanka, starting from October 2025, also VAT will be applied to non-residential digital service providers. The tax authorities are still releasing updates, so that's something that we can keep an eye on. And then in China, a new VAT law has come into effect from January 2026. This could impact the non-digital service providers. So this is something they need to keep an eye on, as they have not formally said that it is for non-residential digital service providers. These changes affect and are evolving the international VAT space. So it is crucial to stay updated and make sure that you are compliant. Before we wrap it up, there are some key takeaways. Digital service VAT isn't as straightforward as it seems. Rules may vary from country to country and are constantly evolving, making it challenging for companies, especially those that are operating across multiple jurisdictions, to stay compliant. It's easy for things to fall through the crack. But the good news is that there is a clear way to address this, whether it's dealing with the historical sales, using the OSS, or just knowing when a local VAT registration is required for the business. Each jurisdiction does have its own processes, so understanding the details is very crucial. For platform and marketplaces, the environment is very complex. Understanding when the VAT responsibility shifts and how to manage this in practice helps prevent issues such as double taxation and missing obligations. If any of the points we have discussed today seems relevant to your business or raise any questions, it's worth taking an extra look at it. And of course, we're here to help. So please feel free. You can send us an email or also ask us in our Q&A question, and we can help from there. So there are going to be a few questions. Please feel free to send us a question. Okay, I think we can see a few. One has said, can you please clarify whether the VAT rate differs from provinces within India and the EU? No. So, for example, India, the VAT rate is 18%, and in EU, it is 5%, and that is the VAT rate for the entire country. However, the tax office wants to know which province the sale was made in, so they could allocate the funds to that province.
I will jump in. I see there's a question where it says, please explain how the marketplace rules would work in Japan and the payments on returns. Considering Japan is a bit more of a unique situation in comparison to some of your other jurisdictions, Japan makes use of something called interim payments. So these are basically continuous or provisional payments that you'll make throughout the year. And this is based on the previous year's annual turnover, just to keep in mind as to how they actually calculate what you need to pay for these interim payments in the first place. So in essence, if you are already or currently registered in Japan, you would continue issuing these interim payments, as the marketplace would now be withholding this VAT liability. So this would be out of pocket for you, but once your annual is due and once that annual is filed, it would obviously be assessed by the tax office, and you would be eligible for a refund with the tax office, depending on that. So if this is something you are dealing with, please also just send us an email and reach out to us. We also do know when it is out of pocket, it might cause cash flow issues, or it might just be an administrative burden all in all. So we are currently in contact with the tax office on ways forward.
Sorry, I also just want to go back to my first question. I realized I said EU and not UAE, which is two completely different things. So the UAE, the VAT rate is 5% for the whole country. However, we do need to file the return per province. I see another one that is saying, have you tried register in Philippines? What has been the known hurdles for that? And can you touch on the B2B VAT invoicing requirements with the reverse charge mechanism in the Philippines and how to handle the VAT by the B2B buyer? Okay, so yes, there is reverse charge in the Philippines, and there's no hurdle we cannot handle. We are pretty good with communicating with the tax officers. So when there is a hurdle, we are not shy to just reach out to them and be like, hey, can you please help out? This is also something that, this is also something that the tax officers are normally happy to assist if there are hurdles that we cannot help. However, there is a standard approach. For invoicing requirements and the B2B, you can send us an email just to clarify on what your business does, as well as who you're selling to, and make sure that they are in the Philippines and if they have valid VAT numbers, as it also can be changed on the type of service you currently do.
Also, just jumping in quickly, we've received a question. We understand there is a VAT and DST system in Kenya. Do we require two separate registrations for these, and are there different rates or returns for each? So no, there's no two separate registrations for Kenya specifically. So essentially no two separate applications. Once you register for VAT, by default, essentially, you're obliged to do your DST, so your digital services tax. And yes, there are different rates. So your VAT is at 16%, and then your DST, so your digital services tax, is, or should I say was rather, 1.5%. Again, keeping that 1.5% in mind should you need to do your backdated VAT returns and have those backdated or historical VAT liabilities. And then your SEP, so your significant economic presence tax, is at 3%. So again, that 3% would apply going forward.
We have another one as well, which is if the software is sourced from the USA and the customer is located in the UK and a VAT registered in Germany, the seller is located in the UK and registered for VAT in Germany. How the VAT applicable will be in this scenario. So just to make sure that my understanding is correct on what the question is asking, is that the end client is in the UK, but they also have a VAT registration number. And then in this case, the service and the establishment of the company, which is the seller, is based in America. So in this scenario, the place of supply would be in the UK, because that is where the service is being used. So therefore, UK VAT will be applicable. So you would need to charge UK VAT to the UK establishment that is using the service. There would be no VAT for the Germany entity, as you are not selling to the German entity. So this would only be if you're selling to the German entity and they are using the service in Germany. So we have reached the 30 minutes. We do see there are a few other questions that we will send emails to directly, as we do have your emails on record. So please also feel free to send us more emails if your question hasn't been answered, or if you have a question after this webinar. But I just want to say the main takeaway is while the VAT space seems complex, it doesn't have to be, and it doesn't have to be overwhelming. With the right guidance and approach, it is manageable. This can ultimately save your business time and money. We are always happy to help, so please feel free to pop us an email and we'll go from there. Thank you everyone for joining the webinar.